Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So if we look here at a chart here, basically a breakdown of the particular different components of this strategy at different market conditions, you can see here right now with the underlying security at 107. On expiration, if the pair value is still sitting at 107, all right, we're going to lose the entire premium of the call. We're going to lose the entire premium of the put, which means that we're going to have a net loss of $3.40. So it's imperative that we understand when we're implementing this straddle that we need the underlying security to make a move, and that's why it's attractive when we have an outlook on the in this case the pair value where it's going to make a big move, but we look at the implied volatility and we can see that relative to where implied volatility is being, that it's somewhat cheap. So as the pair value moves, let's say, to the downside, you can see that the risk on the call option is that $1.90 we've paid for the premium. So as the pair value drops down to 105, down to 102, and down to 100, you'll see that we've lost the entire premium on the call side. The idea is that as the call is depreciating in value, the put option is increasing in value such that we are now beginning to profit. So the drop from 107 to 105, you can see that we've lost 190 on the call, but we've gained back 50 on the put, and this is on expiration. So our net loss, in fact, because we didn't generate enough return on the put to compensate for that call option loss, is going to be down 140. But as the selling on the downside, as that move on the downside accelerates, you can see that the put value is now put value profits are now exceeding the call value losses, such that we're generating a return on our position. Now, conversely, if the pair value actually begins to increase in value, you can see that a move from 107 to 109. In fact, on expiration, nets out, based on what we paid for the premium, a $10 profit. But, of course, the put option is going to expire worthless. Consequently, our loss on that position is going to be mitigated, but at the same time, we're going to see a loss not of the full premium, but of at least $140 here. But as that pair value increases, you can see that our losses on the put premium is capped, and our call premium begins to increase in value. So the main objective here in participating using a straddle is that we believe that option premiums are priced reasonably based on implied volatility, and that there is a high probability that the underlying security is going to make a significant move in either one side or the other. And not only are we going to see an increase in premium based on that move in the underlying, but also in an increase in implied volatility as the market continues to move. Now, you can see here, this is essentially what's known as a risk graph. And what we're looking at here is a risk graph of a standard straddle strategy with the actual price point of the option strikes being in the middle here. And you can see that we assume a loss on either side up until either the calls or the puts, the puts or the calls compensate for the difference in the loss of the other. But as we begin to see the pair value move outside of that range, we can profit on in either direction. The maximum risk exposure is limited to the premiums that we've paid, and the maximum risk is if the underlying security has done nothing between now and the expiration date. Now, the other type of strategy that we can implement in a similar fashion is known as a strangle, and we're still in this case buying a call or buying buying a call and a put option. But in this case, and again on the same pair value, but in this case we're actually using different strikes. So all of the components are the same. We're buying a call and we're buying a put. We're looking at the same pair value, same expiration, but we're actually looking at different strike prices. So in this case, I was looking at the U.S. Versus the Australian dollar here, and once again, what you can see here is that the current implied volatility of, and this is through the FXoptions.com site, but the current implied volatility is sitting around 14 to 15%. If you look at the 52-week high, it's sitting upwards around 29%. 52-week low down around 11% to 11.5%. So if one anticipated that the U.S. dollar was going to increase in value or decrease in value over the next month against the Australian dollar, but you weren't sure what direction it was going to go, then ultimately you could look to take advantage of this strangle strategy. And with the implied volatility being relative to the 52-week high being relatively low, much closer obviously to the 52-week low, you might think that those options are priced reasonably for being a buyer of both the call option and a put option. Now, moving forward, let's say that the AUX is trading at 115.5, and we want to participate by using a strangle. We could buy one March 116.5 call option and pay $2.20, and we could then conversely buy one March 114.5 put option and pay $1.40 for a net cost basis of approximately $3.60. Of course, this doesn't include commissions. So the idea is that we're expecting a move in the underlying pair value significant enough to compensate for the premium that we're paying for this particular strategy. Now, looking at this particular strangle at different prices, you can see here that our starting price is 115.5. Now, as the pair value decreases in value, of course, the call option on expiration is going to be worth 0. And so you can see that we've now realized a full loss of that premium, which in this case is $220 or $2.20 per contract. If the greatest risk, of course, is if the underlying stays the same, we lose the entire premium of the call option, we lose the entire premium of the put option, and consequently our net loss on that position is $360 or $3.60 per strangle. Now, as the pair value drops down to 112.5, 110, and so on and so forth, you can see that the put profits begin to increase and compensate for the loss on the call option, such that if we had a downside target, say, of 108.5, the net profit on that strangle would be $340 when considering the loss on the call and adjusting for the profit on the put option based on that move. Consequently, as we begin to see the pair value trade higher, as we hit 118, 120.5, and 122, you can see that, again, our put option is losing value. Our call option is gaining value, compensating for that loss, resulting in a net profit on the particular strategy itself. But again, it's very important to make sure that you understand the implications of this strategy. You really only want to apply this strategy when you believe there is going to be a significant move in the underlying security, sufficient enough to compensate for the premium that you've paid for the actual straddle itself. So this type of strategy, whether you're going to be a straight-up call option buyer or a straight-up put option buyer based on your outlook, when we're going through periods of relatively low implied volatility, what the market is suggesting is that options are priced reasonably, and it's a good opportunity to be an options buyer.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.